It is Wednesday, January 13th, 2021. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And it was yet another non-virtual get your ass kicked at Jiu-Jitsu Wednesday. Doing some interesting stuff today from the top butterfly guard, you know, like you're crouching in on your opponent and they're down on their back and you're like trying to hammer down on them, and you kind of got to get around that whole guard business before you can get down to business, you know. And so it was basically a I don't know how to explain it. It was a guard pass, starting from the guard pass, then going to side control, and then your opponent, the lower opponent, is supposed to recover the guard, attempt a triangle, and then from the triangle position, navigating back around to a full guard. And I felt like if I went fast enough with that one, that I could probably actually manage a real triangle. There was a movement in it where you're almost at like a bullfight position, you know, where you're kind of up on your side, and you've got one foot in between their legs, like hooking one of their hamstrings, right? And then reaching over the back of the neck and hooking the armpit from the other side. Now, I seem to remember something just like that as a setup for a triangle when I was doing regular jiu-jitsu, or gi'd jiu-jitsu, as the case may be, where you grip the fabric right there at the armpit to secure your grip, and then you bring your leg out from under them, your left leg, and you bring it up over their shoulder where your arm is, right? And then you grab your ankle and pull it around to a triangle. And I think I've actually gotten away with that one once. But I think I actually pulled that one off and got a tap on it once. I made several attempts at it, but I've never. I think I've only had that one where I actually tapped somebody doing that. I don't know. I'm not a big triangle guy. I really like being on top when it comes to jiu-jitsu. I'll just be honest. I mean, I like the dominance. I'm not much of a bottom player, although I do like sweeps. I love sweeps, as a matter of fact. I think that in a really, poor position, you can turn a really poor position into a really great position in not too much effort. It's just a matter of where you're putting your base and where you're setting up your pressures and where you're pulling when you're pulling or pushing, and you get them down. But anyway, so it was a good session. I enjoyed that particular setup myself, and we actually carried it through like a series of pause points where a submission would be available, and so it had the potential for the triangle, got to full guard, and then after full guard, you do an actual sweep, and then ending up with your opponent on top of you, or at least standing rather, with you in a ashigarami situation, getting ready to either get the ankle lock, if you're able to get your opponent down that way, or the heel hook. And I think it's an outside heel hook. Yeah. But anyway, it was good. I got in a lot of reps, but I feel like I need like at least a year more on pretty much everything that we covered today. But yeah, it was good. And I actually did get a round in today of rolling. Or rather, we stopped at the point where I tapped him. I mean, but it was a pretty continuous session. I think we went like at least like 3, maybe 4 minutes, and there were a couple opportunities that he had me at least like the proto beginnings of a submission. But I could feel my head a little more in this round. And what I mean by that is that I wasn't exclusively in a defensive situation, where I was presetting pretty much all of my escapes before he actually settled into the position that he was going to get into in order to submit me. Like, there was one position where he was trying to take my back, and I did something where, like, I put my hand on the outside of his knee or something like that before he even, got into a situation where he could pull off that back take. I'd already parked a hand in front of his knee, and so he wasn't able to hook the leg around my waist. And then he had the other one over, and so then I let him get the other one over, and I think he even had me in a body triangle for a very short period of time. And I managed to navigate out of that as well. And as far as like how I did, he started into a body triangle but he hadn't pulled me up far enough to get me to where I was seated. And that's really where you want to have your opponent if you're trying to sink in a body triangle. Is you want that body triangle to wrap around right on top of their hip bones, to where you're squeezing on just the flesh. You're getting it in between the hip bones and the ribs, and that's really where you want your body triangle. Well, I saw his foot coming over to get the triangle, and he got the triangle, and so I wrapped it from the outside with my left foot and put it into a triangle. And I did that just once, and then I rolled back onto my right side, and he disengaged the triangle. And so I'm pretty sure that's how I got out of it. But anyway, I did manage to navigate out of the body triangle. And what was funny is the start of it was probably the most dangerous thing I've done in a while as far as jiu-jitsu is concerned. I didn't secure my opponent before I did it, and I really should have. But he kind of got me in a what do you call it, a guillotine. While we were standing, he was having a lot of trouble getting me, and then he finally got me into a guillotine, by pulling my head down. And that isn't really bad until you get down. Like, if you fall down to where your hips are lower than their knees, I think it would be, then you're in real trouble there. But if you can stand, and that's pretty much what I did, was I raised my head behind his arm, and that was keeping him from sealing out the choke. But by doing that, I kind of extended him upward, and I put him off balance a little bit. And so I really should have secured him before I did it, because this is actually something that I trained at the last place that I was training. But I took him down with me in a choke. And I managed to swing myself around to where I was in half guard at the end of it. But I did a few things that kind of impressed even me. And one of them was that trip where I did an inside tap on his foot and rolled outward. Like he already had me in a guillotine, but I wasn't dropping down, allowing him to choke me. I was keeping my head back up. And while I was doing that, he wasn't paying attention to his feet. And so I popped my head back and I kicked his foot and took his foot out from under him. But instead of just like rolling it out flat that way, I kind of flipped him over my shoulder kind of thing. But anyway, I took him down, and then I managed to get out of the guillotine. And I don't know, I think that if I would have been a little bit further along as far as like caught back up to speed with training, I think I probably would have tried a kimura, what is that? A ventral kimura, where you got somebody, you got them on their side on the ground with your knees on either side of their head, and then you've got their arm wrapped up in a kimura, and I can't remember if that's like a pectoral or ventral, or I don't know. There's a specific name for that angle of a kimura, and I probably could have gotten it on him, but it's like this guy. I know that this guy has had some additional training. You know, I don't know that he ever got a blue belt or anything like that, but I could tell by the way he was rolling that, you know, he did have a decent amount of experience with regard to jiu-jitsu. And so, you know, it was challenging. It was fun. It was challenging. But in the end, I ended up getting him in an arm triangle. It's like one of my favorite submissions is an arm triangle, because, you know, it's like, it's one of those that like once you lock it in, it's like it's pretty much a done deal. And as a matter of fact, I don't think I actually choked him. He tapped because he could taste blood, or smell blood rather, and you know, he thought he might have been bleeding from the nose or something like that. And, hey, that's as good a reason to tap as any. The fact of the matter is if he hadn't tapped and I just kept squeezing, one or two things would have happened. Either one, I'd have broken his jaw, or number two, he'd have passed out. You know, I'd have gotten it deep enough under his neck that'd have been that. But anyways, a lot of fun. And, you know, I was definitely out of breath. And it was fucked up, man. This whole day was kind of goofy, really. I keep double checking to make sure that I'm actually connected to the internet right now, but this whole day was fucking weird. You know, I went out on I think I went out on Monday, yeah, or Sunday or Monday, I don't know, one of those 2 days, and I went out on the lake, and I ended up getting stranded, like in the middle of the lake, because they were dropping so much water out of the lake that it lost like 4 feet while I was there. And so while I was able to kick out to the spot that I was fishing to, and even that was pretty fucking skinny, I had to literally walk my float tube back, and that was not fun. But I still caught a lot of fish. And one of the reasons for it is because there wasn't any water there for the fish to escape to, you know, so they're pretty much confined to the area that I am fishing, you know, and so the likelihood of me catching them goes way up. But I caught quite a few fish. I think I caught like 5 or 6, and the biggest one I landed, I was really, really happy with it. Because I'd gone out on I think it was Sunday, and I hooked this monster fucking trout. I mean, and when I say a monster trout, I mean 24 to 26 inches monster fucking trout. I mean, easily like 3, maybe 4 pounds worth of trout. Probably heavier than 4, honestly, given the size of it. But I managed to get it in on my ultralight rod, my new ultralight rod. But the one thing I couldn't do is the fish was so heavy, I couldn't get it out of the water with just the lure alone, and I ended up popping the hook I broke the hook that was in its jaw. So, you know, that was unfortunate, but the fish ended up getting away before I could get a picture of it. And like I said, I mean, that was a trophy class rainbow. You know, it's like, I've seen trout that big on the walls of tackle shops and shit around here, and I was always like, where the fuck did you get that fish? You know? And I always thought they were holdovers, because they plant these lakes and whatnot. But an experience I had up on another impoundment that I will not name, that I saw quite a few trout doing the same activity that I'd seen on this other impoundment. And, you know, I'm like, okay, so, you know, they do that here. I wonder if they plant here. And so I looked it up, and in this undisclosed location, they do not plant trout. So I'm like, okay, those are definitely wild trout then. So that means that I'm probably looking at wild trout where I'm at. And I'm more and more I'm of that opinion that like that really big fish that I didn't have a net to land was not a planter trout. It was a native trout. And so, when I think I kind of answered my own question as far as where the hell those huge trout are coming from that people, big enough for people to mount, I think if I'd have landed that fish on a river, they'd have made me count it on my salmon and steelhead card. They'd have been like, that thing's a fucking steelhead. Give me a fucking break. That's a steelhead. Count it. and size-wise, I wouldn't have blamed them. But yeah, so that whole experience was one side of the token. Today was the other side of the token, where there was so much water, and they were raising the water so fast in the lake that between the time that I parked my vehicle and the time that I got back to my vehicle, they'd raised the water so high that the platform that I'd parked my vehicle on was mostly submerged. There was only just the skirt of it still out of the water, and that's exactly where I had parked my vehicle. So the water was literally 2 inches up on my back wheels by the time I got back in. And so with that kind of fluctuation, with them drawing the water down that hard and then raising it up, I mean, you're talking about like 15 feet of water, between where it was when I left today and where it was when I left the other day. And I mean, that is just so unhealthy to do on that lake, and there really isn't any call for it. I can understand drawing down the water because you expect there to be some rain. No problem. Right? With the exception here that the fucking lake was already at low pool. So by drawing it down even more, we drew it down below low pool about like 8 feet. And that's just, like I said, that's just unhealthy. Because all the big fish are now confined really, really tightly to the little fish. And the little fish don't have anywhere to fucking hide. Because it's all out of the water. All the structure that they would normally hide behind, it's all out of the water. It's all up on the shoreline by about 15 feet. So, like I said, it's really unhealthy to do that kind of thing to the lake. And so when I went out there today, I was able to find the fish, meaning where I was, there was all kinds of fish jumping, but I couldn't get them to eat anything. And I have a feeling that when they drew down the lake, they kept it down until the tropical storm that we had went through the next day. That would have been the day to be out there, because they would have been raising the lake, but most of the structure that I was able to see and fish would have still been out of the water. Like the water level would have been where it was at when I hooked that monster fish, rather than fucking 10 feet over that when I got there today. But I don't know, I'm sure I could have fished it a little bit differently and probably seen more success, but I did not get a single fish today. I had a couple bumps, but I couldn't get them to eat anything. I don't know. Next time I go out, I'm probably not even going to take a bass rod, because I haven't been fishing bass at all. I've just been all trout. And one of the problems with fishing threaded line is if you're not getting hit, you can never tell if you're not getting hit because they can see the line, or you're not getting hit because you're not getting hit. And so having a rod with mono on it at the same time that you have a rod that you have thread on it, it's advantageous, because you get in a situation like that where the skunk, you just can't get rid of the fucking skunk. And then you switch up to mono, and then all of a sudden you catch fish again. So that next time I'm probably just going to bring both ultralights instead of an ultralight and a bass rod. Because like I said, last couple times I went out, I barely fished bass. I fished them a little bit today, but not very much, not enough to necessitate bringing another rod. But like the other day when I went out, I didn't use my bass rod at all. I was catching so many trout, and they were all of decent size, so I just said, fuck it. I'm going to fish for trout today. But one of these days, I'm going to catch another one just like that one I lost and get a picture up on it. Anyway, let's go ahead and throw down with some music. And we're going to start with some body count, because that's just what we do. But which song? Well, I've been refraining, although I think I played Bum Rush last time. No, it was Bloodlust. Anyway, we're going to go with this one. Carnivore, First Dance, here on Coin Metal. And that was Disturbed with Enough. As far as what we're going to get into today, I gotta make a minor adjustment here. I'm amazed I didn't actually take care of this earlier. Golly gee willikers. I might actually have to dive back into music. Oh, no, I don't. Because I've got it covered. Got it covered. Alright. As far as what we're going to get into today, got a whole bunch of stuff, really. Let's see here. Oh, that's interesting. Yeah, somebody was trying to tell me that about Ripple's case, and as those of you who listen to the show know, we've covered this in depth. As a matter of fact, I think we probably covered it every single time Ripple has ever been taken to court. It's something that they assumed onto themselves. And, they can complain about it all they want, but there is a reason why Bitcoin did not start as a company. Because Satoshi Nakamoto had observed several similar projects previously, because they did have a centralized entity, corporate entity, or commercial company, somebody who does business and whose business is related and dependent upon the currency, that they would eventually be taken to court and they be chewed down by, fucking reckless investigations and all kinds of shit. Suicide, quote unquote suicides, and so on. And so that's why he didn't do it. But Ripple, they kind of stuffed their head up their own butt, and they said, you know what? Satoshi's a pussy. We think we can do it. And so far, they have done so expertly. And to that end, I tip my hat to them. Okay? I haven't had the best things to say about Ripple in the past. But I'll be honest, I've read through their shit. I've read through their case. I've read through their retorts. And as far as I'm concerned, they're more trustworthy and more principled than the Federal Reserve. And certainly more so than the SEC, who seems to capriciously pursue their mandate randomly. And, I had an argument with somebody earlier concerning the SEC and their choice of targets. And see, somebody was trying to tell me that they were targeting XMR because it's a privacy token, or a coin rather, that has a quote-unquote opaque blockchain. Well, if I can find my transactions on it as a user of XMR, it is not in fact opaque. But beyond that, the fact is that they were going after them because they are among the top market cap coins. It has very, very little to do with the function of the coin, or the persons involved in the coin, or the type of coin it is, or any of that other bullshit. It's got to do with the money. Why do you think they went after ICOs? It wasn't because ICOs were scammy, although some of them were. They went after ICOs because people were making millions in fucking hours, in minutes. And they had to put a fucking stop to that shit. DeFi, I've got to think that either A, they are heavily involved in DeFi, so they really don't give a fuck because they're making money, or there's just so little they could do about DeFi that they leave it alone. They're just like, yeah, whatever. We can't afford to get to it. There's too much shit going on there. But anyway, the point being is they've handled themselves very, very poorly. And they're chasing after Ripple for things that, if they were the case, if they actually had a case, Ripple would be utterly fucked. But the problem with it is that they don't have a case. The way they are pursuing Ripple is they are assuming that XRPs, at least from what I can gather, my interpretation of their case could be wrong. I am not a lawyer. However, my feeling from it, and again, having read the case, having read articles about the case, having read the Ripple's retort, my impression is this, that the SEC is saying that XRPs are securities. If they were in fact to be securities, they would have to represent shares in Ripple Labs, which they do not. They are a product of Ripple Labs. They are not shares of Ripple Labs. And I put it to somebody on Facebook like this, that, a Pizza Hut pizza is not a share of Pizza Hut Inc. It's a product of Pizza Hut Inc. Just like XRP or Ripple is not a share of Ripple Labs. It's a product of Ripple Labs. Ripple Labs' whole business is selling XRP. That's pretty much it. And maintaining their network. Allowing partners onto their network. So on and so forth. That's about the extent of what they do. And their customers have been, I gotta guess, pretty damn happy about that. As a matter of fact, the only people that seem to be bitching about XRP are not necessarily people that use XRP, but people who invested in XRP and didn't make the money they thought they were gonna make. Too fucking bad. You're not guaranteed shit here. If you didn't bother to investigate the coin in question, that is your fault. That is not the fault of XRP. It's not the fault of fucking any coin or token in this space. That is on you. There is literally nothing anybody can do to stop the existence of scams. It's impossible. And as a matter of fact, the reason for a lot of it is that you will have legitimate companies, and then for whatever reason they lose users, they lose clients, for whatever reason they decide that they need to adopt more than scammy ways of generating money. I'll give you a good example. As well as Fargo. These guys were so desperate to make money that they allowed their bankers, or their tellers rather, or actually instructed them to, create accounts in the names of their clients and manage those accounts on their own. And they would like charge them like overdraw fees and shit like that, where they would bill the account that the person didn't know about instead of the one that they do know about. They would send the bill to the one that doesn't have any money in it, or has whatever money they actually put in it. And when it would get overdrawn, they'd hit their normal account with the fee. They do all kinds of shit like that. They did get taken to court for that, and I believe they aren't doing it yet, or doing it again yet. They might be. I don't know. Might be a regular business practice. Who knows? We don't. Or another one is like a transaction reordering. That's always fun. they're free to process the transactions as they see fit. So they're not necessarily obligated to observe the full 72-hour period on each transaction, whether it be going in or out. That's up to their discretion. And so I had this big problem with my bank where they would order my transactions that would always be at their advantage. So if I didn't make my deposits before I made withdrawals, it's hard to explain that. I would have money in the account, but then I would do a withdrawal, where I would go and I would buy stock or something like that for my business, and then the bunch of little transactions that I had going out would all get billed after they took out the money from buying stock. So I'd have like $1,800 in the account, right? And then I would be making a purchase for say $2,000 worth of stuff, but I made like $300 worth of deposits in the same day that I make the $2,000 withdrawal. Now, regardless of when I did this, if I made the deposit and then made the withdrawal where I wrote the check, they would count the check first. Where I wrote the check for stock, they'd suck, the $2,000 out of my account. So now I'm $200 in the hole, right? And then any transactions, gas, anything like that, they'd nick me for $25 for every single one of them. And then in addition, if there was any kind of day drift in between, they would count that against me too. So I would have the existing bills, and then for every single one of those transactions, I would get nicked another $7 every day that it was in the arrears. So it's like, really, that is such a fuck story when it comes to processing transactions digitally. And in this way, I think Bitcoin has already been fucked up. That because they do things like RBF, they can time the transactions to where your withdrawals come out first, despite the fact you had intermediate deposits that would have been refreshing your account if all of your transactions were processed in an as-received method. But they are not. They are being processed according to what is advantageous for the miners. And that's all fun and games until it's actually bankers that are doing the mining. And I caught on to this thing, and it seemed kind of interesting to me with regard to the way the crypto economy is kind of budding, developing. I'm trying to find the exact article about it here. Where is it? Is it way down here? I don't think so. But it might be. So I'm gonna look. Here we go. And so, this is on CoinDesk, how the OCC is building crypto America and saving banks from extinction. No, they're not really, but this is by Lex Sokolin, and this is authored on January 12th, 2021 at 1:24 p.m. PST. So yes, penis. Over the past 12 years, $1 trillion of value has appreciated into existence. It may be a little more or a little less tomorrow. Give a few 100 billion. It may one day reach 10 trillion or 100 trillion, or stay at 1 trillion forever. It may even go to zero. But regardless of all of that, $1 trillion of value has indeed materialized and grown on blockchain-based financial networks since 2008. If you are a financial advisor or a trust company, you have missed out on $1 trillion in capital appreciation for your customers. Regardless of how we spin it, the core fact is that crypto assets have largely been unadvised. They have not been distributed by fiducians to the mass market. Instead, they have either 1. Been directly owned by retail investors through crypto exchanges or decentralized apps, or number 2, been packaged and secured for safe handling by newly buy-side funds for the largest endowments and family offices in the world. That means retail and mass affluent investors are doing it for themselves at Coinbase or Binance or MetaMask. This pattern joins a similar fact base for stock trading. Passive exchange-traded fund asset allocation assets have gone through the roof, in part because they are the choice of fee-based financial advisors and wirehouses that now control about $10 trillion in assets under management. Selling a diversified cheap asset allocation as your core investment is a stable market equilibrium. It is logic. It is statistics. It is math incarnate. Who will argue with Bill Sharp? But the animal spirits, John Keynes' John Keynes' term for what drives investors are emotion and feeling. The animal spirits are narrative and story. The animal spirits are inequity, wealth redistribution, billionaire witch hunts, and revolution. And the animal spirits are a cry for help from under a massive, endless pile of useless, unavoidable debt. Instead of financial advisors or other CFAs guiding the retail market in good decision-making, a newsfeed of what's popular has driven Apple, Google, Tesla, and other John Galt hallucinations to the stratosphere. Don't get us wrong. We love the robot as much as the next fintech commentator, but it is clear to us that, quote, the masses are not being advised, and that the capital appreciation that matters, cementing the next trillion-dollar networks for global future generations in work yet to emerge, is misunderstood and misrepresented by most financial professionals to their clients. Your clients won't be your clients if crypto hits 10 trillion. As a reminder, total US M1 money supply is about 7 trillion. The tech market caps on the Nasdaq during the dot-com bubble were 3 trillion. All gold ever mined is 8 trillion. Global FX reserves are 10 trillion. Total equities are around 100 trillion, and all asset classes, including real estate, art, and pork bellies, add up to about $500 trillion. So, the crazies are not crazy for being crazy. The OCC White Knight. It is in this context that we want you to understand the recent, quote, interpretive letters from the Office of the Comptroller of the Currency. But first, the background. American financial regulation is an alphabet soup and has grown out of politics and crises. It looks to the past, taking the fact patterns in mistakes underlying market crashes and banking crises to create executive structures that prevent those same mistakes happening again. Bank and investment advisors are under the supervision of different authorities. Banks can't sell you stock, generally, and wealth managers can't sell you bank accounts, generally, though, of course, they can if packaged up into a bank holding company. If you're big, you can do anything. The OCC is part of the U.S. Treasury Department, so is the Financial Crimes Network, FinCEN, as well as the Internal Revenue Service. FinCEN wants to make sure you don't launder money and that know your customer / anti-money laundering information is sufficiently captured to allow some amount of sovereign control and leverage over the monies within the U.S. economy. The OCC has a different set of goals. It supervises banks and it wants to make them safe and competitive. Anyway. The current acting comptroller of the OCC is Brian Brooks, a former chief legal officer of Coinbase, the crypto brokerage, though he will reportedly be leaving the OCC soon. While the Treasury Secretary Steven Mnuchin is skeptical of cryptocurrencies, Brooks is a clear proponent. But it doesn't boil down to just personality. There is structural, causal complexity underneath. While there are about 4,000 banks in the U.S. and about as many credit unions, some of them are federally chartered under the OCC, and some of them are state chartered. You can see that the overall share of regulated banking entities at the federal level is hovering around 20 to 30%. This creates a novel tension and a couple of key dynamics. First, there are large returns to scale in being a bank. Assets at the giant federally regulated banks like Citi and JP Morgan Chase are ballooning. Deposits at small state-scale banks are falling. Second, fintechs, ergo Square and Sophie, are naturally availing themselves to intrastate commerce by having a digital distribution footprint. They default to seeking federal charters as well. This is why the OCC has spent so many calories on defining special-purpose fintech charters, and why the local community bodies hate it. Being a national body, the OCC competes with other national regulators like the Financial Conduct Authority in the UK or the Monetary Authority in Singapore for the best financial regulatory product. It must attract global capital and global talent. It is counterparty to organizations that engage in such games. So you can think of the OCC's crypto posture as either number one, resulting from the DNA of the organization, or number two, the impact of third-party pressure on the organization. The most credible critics suggest option 2, i.e. regulatory capture by the industry, are Angela Watch and Tim Swanson. Yeah, that's actually why. I do not want to mischaracterize their arguments, so I recommend you click on the links. At the core, their concerns focus on shadow banking, i.e. risky, non-banking banking, and the mismatches in goals between non-expert crypto developers and economic policy experts. The state-level authorities play a different game. They participate in interstate competition, i.e. is New York better than Wyoming, and try to minimize the influence of federal overreach. Economically larger states want to defend their current position, including defending their large banking constituents, while smaller states want to lower switching costs, so new entrants choose to charter there. This is why Wyoming pioneered a banking charter with Caitlin Long, which has been granted to crypto exchange Kraken in September of 2020 and is now available to others. Now let's say you are the OCC. A state like Wyoming has set precedent, almost like the legalization of cannabis use or the adoption of other progressive social policies. You see China launching a central bank digital currency. You see the Ethereum ecosystem with $25 billion in stablecoin deposits. You see American companies building US dollar-denominated digital asset products to compete globally. You see Facebook and Google trying to eat into your banking sector. How do you defend your turf? How do you start to lay down the road brick by brick? Where is the road going? On July 22, 2020, the OCC published Interpretive Letter 1170, allowing national banks can custody crypto assets. On September 21st, 2020, the OCC published Interpretive Letter 1172 on holding stablecoin reserves. National banks can hold stablecoin reserves for customers. On January 4th, 2021, the OCC published the OCC Chief Counsel's view on the use of independent node verification networks and stablecoins for payment activities. National banks can run blockchain nodes and use stablecoins for payments. You can see the jigsaw puzzle coming together even if the OCC's letters are not the letter of the law. They can be challenged in court, and they can be rewritten by Congress through legislation. But they are today's guidance for the financial industry, and in particular, the national banking giants that hold $5 trillion of depository assets. Wells Fargo, Citigroup, and JP Morgan are, by the stroke of the pen, crypto asset custodians, crypto payment companies, and miners in blockchain networks. What this means for the future. Allow us for a moment to raise our head above the trees and look at the forest. Banks are quasi-public/private institutions attached to sovereign power. The central bank adjusts money supply to imperfectly target inflation, employment, and growth. Banks create leverage of that money supply by lending out the money to consumers and businesses, which then circulates, gets deposited, and lent out again. Narrow money of M1 today is about $6 trillion, while M2 is around $19 trillion, about 3 times as large. This is a loose example of private sector leverage that funds growth. On the crypto side, a similar thing is happening in decentralized finance. Instead of sovereign power, money is backed by software and the collateral it secures. In depositing Ethereum or other assets into Maker, you mint the DAI stablecoin. This can then be used to purchase other assets, which can be committed as collateral in lending markets like AVE or Compound to generate yield. Staked assets can then be further structured or wrapped into pools that earn market-making fees on Yearn or elsewhere. Money is levered up and expands, creating leverage. Bitcoin remains scarce, as does Ether. Financial industries apply those scarce assets to economies and hopefully productive investment. Back in the bank world, the banks must keep regulatory capital buffers to, quote, ensure the stability of the overall system. There is some percentage of assets committed against systemic collapse. To be a node in the traditional financial system, you must put capital aside to prevent a run on the bank and generate some sort of, quote, trust in the entire game. The capital yields a particular return and must have a certain low-risk profile. Bank of America alone has over $150 billion in such capital. We think there is an analogy and a lesson to be drawn here to crypto miners. The next generation crypto protocols use some staking rather than proof-of-work mining concepts. Whether you are a liquidity pool provider in DeFi or staking within Ethereum 2.0 to generate consensus, the committed capital is returning some rate of return for standing up a financial service. That capital is generating trust in the overall network and a collateralization buffer in certain instances. While the analogy is not exact, we hear the rhyme in the poetry. Banks should be large-scale miners or validators of blockchain networks. They already know how to do this. Many crypto natives will proclaim that this would imply a takeover by the system by financial incumbents. That's too simplistic. It would imply interoperability between existing economies and Web 3.0. It would bridge the capital. As you can tell, I've just lost all interest in this asshole's thesis. The only reason Bitcoin has any value whatsoever is because it isn't banks that are fucking mining it. It's you that is mining it. Oh, just trust us. Trust the banks. Trust the banks. Yeah. Yeah, that's exactly what you got in here for, isn't it? Is because you trust banks. If you trusted banks, why aren't you using a fucking Visa card? Give me a fucking break. And if you're, this is the last line in it. And if you're paying attention, it has already happened with the OCC opening the door. No, it hasn't happened. This is all a bunch of bullshit. I shouldn't have even bothered reading this. This guy, Lex, yeah, you're fucking incorrect, Lex. If you trust banks, stick with fucking Visa. The whole reason crypto even exists is because a lack of that trust has come up in the market, and crypto has given it a place to express itself. I'm really kind of saddened. I mean, I'm looking at this guy, and he's obviously in his like 20s or 30s, so he's old enough to have gotten into this, but I'm sure he's looking at it from the position of somebody who is not necessarily a bank teller, but maybe somebody who's like managing bank tellers. You know, and all he's thinking about is fees and banks and fees, and oh, got to make more fees for my bank, got to make more fees for my bank. They're not going to save banks from extinction. And in this episode, I intend to disclose why. You know, the fact of the matter is that you don't need banks. You don't need them to mine it. You don't need them to process transactions. You don't need banks in cryptocurrency. And trying to reimpose that. I mean, like, this is the kind of thing that you'd be able to do on the Lightning Network. They probably wouldn't be able to, well, I don't know, I suppose you could probably do the transactions involved itself on the Bitcoin network. But the number of transactions you would be doing would make it kind of cost prohibitive to do it that way. Anyway, this is on Reuters.com. UBS to charge negative rates on holdings above 250 SFR euros, and this is a memo. This is by the Reuters staff, Zurich, and this is authored on January 12th. UBS will begin charging clients with cash balances over 250,000 Swiss francs, approximately $280,646.61, a 0.75 interest rate fee from July. Switzerland's biggest bank said in an internal memo on Tuesday, quote, "It's becoming increasingly clear that we'll have to contend with negative interest rates for years to come. That's why we've decided to lower the threshold for deposit fees," Swiss banking head Axel Lehmann told employees in the memo. The bank would factor in mortgages and investments clients had with the bank to determine whether to apply the charge. Quote, "In the end, less than 5% of our clients will be affected," Lehman said in the memo seen by Reuters and confirmed by a bank spokesperson. Yeah, that was really short. But yeah, I don't think that's going to make UBS really, really popular. As a matter of fact, it'll probably make some of their customers who have over 250,000 euros worth of holdings to withdraw those holdings and move them elsewhere. But yeah, let's go ahead and throw down with some music. And as far as where to go, got some Sepultura playing in the background. I'm feeling like we should play some. But maybe not first. Fuck it. Here we go. Altered State. Here on Coin Metal. And that was Iron Maiden with 2 minutes to midnight. And so, as far as what else I wanted to get into today, got the tabs open. They're bringing on up to front. Maybe no. Here we go. I thought this was pretty hilarious, really, because these guys have been chasing after Ripple for a few years now, and they catch them, and or not really catch them, but corner them. We'll just say that, corner them, and then this happens. And this is on Decrypt.co. SEC enforcer behind $1.3 billion Ripple lawsuit stepping down. And this is by Jeff Benson, and it was authored on January 12th, 2021. So yes, penis. Mark P. Berger, who was named Deputy Director of the Division of Enforcement at the U.S. Securities and Exchange Commission in August 2020, is leaving the agency before the end of the month, according to an SEC press release. He was appointed Acting Director of the Division after Stephanie Avakian departed from the SEC in December. Through Berger's time in the top position, though Berger's time in the top position was short, it bears at least one major highlight: the SEC's $1.3 billion lawsuit against Ripple Labs CEO Brad Garlinghouse and executive Chris Larsen. The lawsuit, which was unveiled at the tail end of Avakian's tenure, alleges Ripple did not register the sale of XRP, the third largest cryptocurrency by market capitalization. The SEC views XRP as a security, a tradable investment contract that raises funds for a business or organization. Yeah, that's not what Ripple is at all. Ripple was invented by Ripple founders Larsen and Arthur Brito and Jed McCaleb, as well as current Ripple CTO David Schwartz. It aims to be a cryptocurrency enabling banks to more efficiently transfer money. But, according to the SEC, Larsen and Garlinghouse sold XRP given to them by the company in order to get rich. The SEC also alleges that Ripple paid companies to use XRP and therefore prop up the price. The lawsuit, filed in New York federal court on December 22nd, sent XRP's price into a spiral. On December 21st, the asset traded for as high as 55 cents. Now it's at 29 cents and has been dropped by several exchanges, such as Coinbase. Berger can also take partial credit for the SEC's enforcement action against Telegram, which compelled the messaging platform company to return $1.2 billion to those who invested in its cryptocurrency offering, Grams. Digital tokens never got off the ground. In addition to ICO-related enforcement actions, Berger also played a role in enforcing securities laws and protecting investors, including taking actions against prominent firms Robinhood Financial LLC, Deutsche Bank AG, and Luckin Coffee. Things are in flux at the SEC as federal government transitions from a Trump presidency to a Biden administration on January 20th. President-elect Joe Biden is expected to name former Commodities Futures Trading Commission Chair Gary Gensler to fill the role of the SEC Chair. Jay Clayton stepped down in December. The SEC has not named a new enforcement director. Interesting. Yeah, I think that they did a really dumb thing by even bothering to try to fuck with Ripple. And I think in the long run they're going to be made to regret that, because Ripple actually offered to settle this out of court, but the fact that it's being taken to court means that money is going to be tied up in it from the court, and people's time is going to get wasted on it. And time is money, as we all know. So, it's like, it's one of those things where I think ultimately if it does go to quote-unquote court, the court's going to take a look at it, and if the judge has half a brain, they're going to throw the fucking thing out. They're just going to, no, this is a bunch of bullshit. But that's just me. Anyway, as far as what else I wanted to get into here, we got that one. This is kind of interesting. And this is on Coindesk.com. Visa abandons $5.3 billion acquisition of Plaid over DOJ antitrust concerns. I think we're probably going to see the DOJ get more active on that, especially with like Google and Facebook and shit. Anyway, continuing. This is by Zach Seward, and it was authored on January 22nd, 2021 at 2:13 p.m. PST. Visa called off its acquisition of Plaid, the fintech firm serving as a fiat bridge for a number of crypto and decentralized finance applications. The U.S. Department of Justice, DOJ, announced Tuesday that the two companies have officially called off their planned $5.3 billion merger in the wake of the DOJ's lawsuit last year that sought to block the deal. The DOJ filed a civil antitrust suit on November 5, 2020 to stop the merger, claiming Visa is a monopolist in online debit, charging both consumers and merchants billions of dollars in fees each year to process online payments. Quote, now that Visa has abandoned its anti-competitive merger, Plaid and other future fintech innovators are free to develop potential alternatives to Visa's online debit services, Assistant Attorney General Macon Del Raham said in a statement. Quote, with more competition, consumers can expect lower prices and better services. Holy shit, somebody who makes sense. Anyway, so yeah, that's kind of interesting. I don't expect that Visa's actually going to need to make any additional acquisitions. I mean, they already have a significant percentage of the digital finance industry, I guess, would be the appropriate word, or at least digital transactions, right? They're pretty established in the market there. And as such, I don't see that they're going away anytime soon. But anyway, I do have one additional thing I really wanted to get into, and this is by Andre Conji. My apologies, Andre. And this is authored on February 28th, 2020. And the reason I'm going back that far is because he actually wrote a follow-up to this article. And so, anyway, continuing on. Building in DeFi Sucks by Andre Conji. Not a sensationalist title. Honestly, it sucks. It's expensive, the community is hostile, the users are entitled. When I started building Yearn.finance, I thought to myself, here is something 100% free, feeless, honestly a common good that makes good yield with low risk. How could people not be happy with it? So let's talk about the stuff we aren't supposed to talk about, shall we? The stuff that people will tell me after this article to suck it up. It's, quote, part of the game. Let's start with the users. No matter what you do, they will be unhappy, and they will make a point of telling you so. And this is a tweet, Ferdinand_Hodler. It's a shame that Yearn.finance can't take constructive criticism and recommendations. Yes, it's a free service developed as a hobby, but if you don't want to answer simple questions about people's money, then don't fucking make it public. Make it a public service, zapping out Yearn.finance. Yeah. The laugh responds, I see your point. 80 says, man, I've said it once and I'll say it again. If they don't give me complete satisfactory answers to my questions, then something is up. I just lay and watch them like a lion. Curve Finance and Yearn Finance don't give me the answers I was looking for. Rick says, I find bugs in people. I am damn good at it. These people are buggy as hell. 80 says, I'm going to start following you. Thank God it's still some decent people out here that like to sleep good at night knowing they are not screwing people over their hard-earned money. These are just 2 examples, but honestly these negative statements occur daily. And again, I don't know what these people expect. I mean, I am a one-man team. I don't have funding. I don't have support. I'm not charging fees or making any revenue. I can't do customer support 24/7. How am I supposed to operate? And let's not forget the constant comparisons and, quote, soft shells. Iron.finance, Ferdinand says, well, I hate to make a comparison, but idle.finance is that simple, deposit redeem, although it has less integration than Iron, which is why I wanted to try it. To the devs, I suggest creating a page in Iron that clearly shows the initial amount and the current value along with ROI percentage and fees. This will help noobs and will avoid people asking you the same questions over and over again via Telegram and will allow you to focus on development. You are familiar with idle.finance, you can take a look at their dashboard and pull details. It's simple yet informative. It will also help with greater adoption in Iron. I'm not new to DeFi, but it still took me a little while to understand what was going on in the background, and even though I went through all of the documentation before I started using it. Don't get me wrong, it's a great product, what you are building, but it is not clear enough. Next up, the community. Constantly looking for a bit of information to pick you apart. Aaron, Fiat Minimalist, getting news from a very legit source that one of Curve Finance's smart contracts has been drained of millions of US dollars just minutes ago. Correction, fault is with Zap's slippage. Iron.finance, incorrect information. One of Zap's was used to withdraw $450,000 worth of Curve tokens for $25,000 worth of USDC. We are trying to get hold of this individual and make them whole. In fact, all that happened was the pool got plus 90% APR. Let's see, Brennan from Dharma says, based on this TX, it appears the users sent 89,000 USDC and received 450,000 BUSD. Seems like this individual is already more than whole. In fact, it seems like they made $365,000. Leshner says, can you confirm or walk viewers through the transaction? It appears that the standard Ethereum address was not a Zap, sent 89,000 in and took 465,000 out of Curve. Seconds later, they made a profitable trade. Now, Rick says, you have been laughing in the Telegram group, but you still have not explained to us whether this person has lost money. I think the lack of professionalism is absolutely terrible. Be better. Tell us what happened. Fubulobu says, well, I wish they quoted the other parts of my messages instead of that one cheeky message. I knew that would come back and bite me in the ass. And apparently they had said, Michael, some of the fun happened at yet unannounced pool HTT. Viper is so good. Our bugs actually make users more money instead of taking it from them. That's funny. The next one here is by Chris Bleck. Very strange TX noted on y.curve.fi. Someone swapped 89,000 in USDC for 465,000 in BUSD. It's still unclear what exactly happened, but earlier reports are that it involved a zap. This TX was 20 hours ago, so we're overdue for a disclosure. Let's see, Iron.Finance's full post-mortem to follow, but since there's currently a lot of wrong information out there, I did a quick gist of the transactions in question for everyone, and so apparently he explained it. Let's see here. Yeah, I'm not going to read the tweets anymore. Let's get down to the message he's trying to make here. Do me a favor and just read that last poll. Let's see here. Feel free to place your no-loss bets on what's happening in hacking themselves again, LOL themselves to sleep, figuring out parity trace, or potatoes. Do me a favor and just read that last poll. Did any of those other community supporters contact me privately to first get information or attempt to understand the picture before they did full demands in public on Twitter? Nope. I had to wake up at 3 a.m. to do further explanations on Twitter that were demanded of me, which I was already busy writing a Medium post for, and I mean, it's on-chain data, people. Not like anyone can't look at the transactions. It's expensive. The expenses I explained in previous posts and really aren't really relevant to this specific rant, so just going to skip over it for now. Plea for change. Honestly, if this keeps up, we won't see people trying to innovate in this space. All we'll see is teams constantly trying to attack each other and break each other down, or teams that come in, do a quick ICO raise, and then disappear. Well, this is the status quo. Why would anyone try to build something here? I need to seriously reflect and consider if I want to still be involved in a space this antagonistic and hostile, especially when I try to do this as a common good. And so that was the pretext, and it looks like we'll actually have enough time to go through the next part. And so this is Building in DeFi Sucks Part 2. Let me get a sip of water here really quick. And this was authored approximately 16 hours ago by Andre Kanji. It has been almost a year since the first time I wrote these words, and that was what we just read. Any industry has its good and its bad. You leave an industry when the bad outweighs the good. I'm still here. So don't get me wrong, there is good. The purpose of me writing this follow-up is to rant, which I find therapeutic, and also to let other developers know it's okay. It can be shit, and maybe even it will be shit. This is only the bad, not the good. Take it in context. Development takes time, much longer than even you as a developer think it will. 9 out of 10 ideas will fail. You can spend months or years building on something that conceptually you thought would take a few weeks. This is part of the process. This in itself can be demotivating, but now add hundreds, sometimes thousands of people shouting on Telegram, Discord, and Twitter, quote, "When will it be released? Why hasn't it been released? Give us an update," and often significantly more hostile messages. So take something that is already difficult and make it exponentially worse. As DeFi developers, our work is incredibly public, and the good, the more eyes, more peer review, faster development cycles. The bad, your mistakes are used as ammunition against you and will be used for weeks and months after they've been rectified, your delays are seen as incompetence, and your failures are amplified tenfold. So there is already immense pressure to constantly be releasing new updates, and this creates a very stressful development environment. And what happens after you release it? When is the next upgrade? What is being built next? Give us an update, because you see, no one was actually waiting for your development. They were waiting for a price-shifting event. They don't actually want to use your product. They only want to use the narrative of your product to make money. Real users are scarce. For all the billions we have in DeFi right now, if you strip away the subsidies paying for users, this number will collapse. People don't care about your asset management system. They just want to farm tokens. People don't care what they can care that they can protect their losses. They just want value token to go up. People don't care that you manage to halve your gas costs. It doesn't help their net worth grow. There are only truly amazing products out there. There are some truly amazing products out there in the DeFi currently. But if you remove the token and you remove the token printer, usage would drop to negligible. One of my core motivators is having users use what I build. And I can build the superior product even, but a competitor can just fork my code and a token that infinitely mints, and they'll have twice the users in a week. Motivating to keep building, right? Your value is only as good as your token. Token go up, you built an amazing protocol, it's the future of finance, blah blah. Token goes down, you're a scammer, fake project, bad coder, blah blah. Be prepared for this. It can get exhausting. Also, when the token goes up, traders with their quote TA will take 80% of the credit. If the token goes down, you will get 100% of the blame. Your success belongs to your quote community, but your failure is 100% your own. Token goes up in value, no one is going to be giving profits to you or thanking you for their profits. Some exploit occurs, you are 100% to blame and need to refund or figure out ways to make them whole again. You have 0% of the reward and 100% of the risk. Don't give away your tokens. This one is less general and more of a lesson learned by me specifically. When I decided to distribute YFI 100%, it was because I believed it would allow me to exit the community. However, I am still blamed if the price goes down. I am still constantly plagued by, quote, when next release, when update, etc. messages. I still have all the responsibility and expectation, except I have 0% of the reward or upside. Don't do this. I was an idiot. Building is expensive. Don't even bother unless you have a few 100,000 sitting around. Even with the tokens I farmed in Wi-Fi, the development costs put me far in the negative. The KP3R is even worse. Had I not built either, I would have been better off financially today than I am. I guess this one comes back to don't give away your tokens. Community is bullshit. So, my theory was as follows. If someone has the token, it is in their best interest to do whatever they can to increase the value of their token. How naive I was. And I guess this is partly our own fault as a DeFi community for calling it governance tokens. Because all the people want to do is govern, but not in the trenches helping the fight. Instead, on their throne is a dictator simply shouting orders while their platform developers need to execute. They don't care about your protocol, they don't care about you. And would just as soon sell that token when they no longer think you are contributing enough by their standards. Not them, you. They don't try to add value, but they will be happy spending endless hours of your time asking you for updates and for you to explain in detail your thought processes and endless back and forth on the most pointless menial topics. Governance and community kill innovation and development. Don't do it. That's not true at all. My best advice, honestly, don't be a dev. You will need to be some kind of sick masochist to be a dev in this space. Be a shitcoin trader. You can meme and shitpost all day long in Telegram chats and Twitter. You can harass development teams for updates. If you happen to guess right and your shitcoin goes up, you get to claim all the clout. If it goes down, you get to blame the project. You will make significantly more money, and even if your call was wrong, you can just claim it was psyops to get someone to liquidate you. Why would you want to suffer all the costs, all the responsibility, and all the risk with a fraction, or in my dumbass case, none, of the reward? Yeah, it's a good question, but we still do it anyway. I mean, it's like this show. I mean, how long have I been doing this show? About 5 years now. And I'm not doing it for commercial gain. I'm doing it because I believe in what's going on here. And I think somebody should be out there in the front, or maybe not in the absolute front, but trying to break it down for people. Because, you know, most of the people you listen to talk about this stuff in this space, they always couch it in, oh, you know, you got to be hyper technical, you got to know how to code, you got to, no. It's just a bunch of bullshit. You are more than capable right now of picking up a book and learning the essentials of how to create a cryptocurrency, how to manage a cryptocurrency, how to code, how to write an app. These things have never been closer to your grip, and, you know, looking past them to jump into immediate profits with trading is just silly. Try to generate wealth, or value at least, with what you can do. And maybe shitposting is all it can be right now. But at least try and make it accurate. Anyway, let's go ahead and throw back down with some music. And we haven't played down in like forever. Let me see here. Here we go. Bury Me in Smoke. Here on Coin Metal. And that was Powerman 5000 with Nobody's Real. And so, it is with that I'd like to bring this episode to a close. Thank you very much for listening. I certainly do appreciate the support. We will be back again on Friday at 8 p.m. Pacific Standard Time. And so until then, I want y'all to trade safe. Do your homework. And watch out for your own bunghole, because nobody else is going to do it for you. And as far as our last dance is concerned, I think this one's kind of appropriate. 9 Inch Nails, Mr. Self-Destruct, Last Dance, here on Coin Metal. Thank you again for listening, and y'all have an excellent evening. Good night.